In this lecture, we are going to examine the important idea of support and resistance lines in its two variations. The most common of these variations is the horizontal type. The less common, and perhaps more powerful variation is the slope type. Before we go into greater detail about the more advanced use of these important lines, let's overview the basic structure that holds this concept in place. Support and resistance lines are basically barriers that price tends to respect based on the idea of market memory. When traders analyze the recent past of price, they tend to look at price extremes as areas where buyers or sellers might show up again. That happens to be the case many times. The other common attribute of support and resistance lines is their switching dynamic. For example, if price encounters a support line, tests it a few times, and then zoom it down, this support line switches from support to resistance because price is now below the line, and it has already been tested as a valid barrier for price. The opposite is also true, of course. If price encounters a resistance line, tests it a few times, and then zoom it up, this resistance line switches from resistance to support because price is now above the line, and it has already been tested as a valid barrier for price. Another attribute that is worthy of pointing out is the fact that such lines can act as a barrier, but they can also act as a catapult for price. For example, if price decides to break a support-resistance line, it will do that with an increased volatility most of the times. We call this movement a zoom through the line. This is the basic framework of support and resistance lines. Now let's move on to a more complicated idea, which involves the principles of multi-timeframe analysis and the hierarchy of signals. Previously in the lecture, we talked about the idea of market memory, and how this is the underlying principle that holds the idea of support and resistance lines in place. However, the notion of market memory is relative to the temporal observation of the market. For example, in the daily chart, a support-resistance line might come out of a high or low that happened 20 days ago. On the other hand, a meaningful support-resistance line on the 5-minute chart might come from a high or low that happened only 1 hour ago. This basically means that the power of these lines is attached to the temporal framework in which they appear. The cool thing about using contextual trading, multi-timeframe analysis and the hierarchy between trading signals is that we can use support-resistance lines from higher timeframes to build a trading context for lower timeframes. The true advantage comes from the hierarchy between trading signals. To understand this idea, just imagine the power of a support-resistance line that comes from the 4-hour timeframe on a context built for the 5-minute timeframe. The line drawn in the 4-hour timeframe has a lot more power attributed to it, so it might sparkle a more violent reaction in lower timeframes. With that said, we can advance this principle even further by understanding the less common application of support-resistance lines, which is the sloped or angled type. Sloped support and resistance lines work under the exact same principles as the horizontal type. The only difference is that these lines have to be drawn in some sort of angle to fit under this category. The possibility to draw sloped lines that function within the same axioms that sustain the idea of horizontal support-resistance lines poses a huge potential. That happens because by drawing such sloped lines, we can find many different market angles that would simply pass unnoticed otherwise. The idea of sloped support-resistance lines gives rise to the idea of energy points in price. An energy point is a level where two support-resistance lines with different angles meet. That can happen when a horizontal line meets a sloped line or when two or more sloped lines meet in a common point. The idea of energy points is that when they converge to the same point or level, they produce an amplified effect on the attributes of common support-resistance lines. These energy points can be useful to place target orders, for example. Another interesting property of sloped support-resistance lines is the fact that we can extend these lines to other important highs and lows in the market respecting the angle in which they were originally drawn. This is a powerful technique that might greatly enrich the context of a trade and point out to the edges of the market with an almost perfect precision. However, these types of lines have their downside. Since a trader can find an incredible amount of these in any given market scenario, the trader should be careful in selecting the lines he is going to use in his context formation. There is a large set of lines that can be found in the market at all times, but only a small subset of these lines is valid. The antidote to this problem is to reverse engineer the context by using these lines after some other converging points between other techniques have been found already. By doing that, you can select only the lines that seem to be more relevant to your context. Keep in mind that we are only looking at the concept behind the support-resistance lines. These ideas must be implemented in practice in order to be fully understood, as we will do in future lectures. In the next video, we are going to explore the idea of price action reading within the context of bar or candle interpretation.